Are you looking to buy a house in the $800,000 price range and want to know if you make enough money or what the payments would look like? Well, if so, you're in the right place. But before we get started, in order to be compliant, let me introduce myself. My name is Linda Shinpaw. I am a licensed loan originator. I am powered by Edge Home Finance Corporation, and we are the #1 national mortgage brokerage in the U.S. All right. Can you afford an $825,000 loan? That's the scenario I'm going to play out for you today. Before we answer that question, we're going to talk about the lender's calculation that happens on every file, the best payment for you, which may not necessarily be maxing out your pre-approval, and residual income. So don't worry, we're going to do this in a very simple way, but it's important that you understand how all of these work together in order to buy a house. So this calculation, this math that mysteriously happens in the background, it all starts with the DTI ratio. That is your debt to income ratio. So basically all we're doing is we're taking your monthly debts or a portion of them, and then we're dividing that by your gross monthly income. Now, what debts do we care about from a residential mortgage standpoint? Well, things like car loans. If you have multiple car loans, you might consider streamlining those down to just the one or two that you really need, because any of those payments that are on your credit report are going to get used against you and take away from what you could use to qualify for a mortgage payment. Student loans. I know a lot of you have them. It's very, very normal. I have a lot of clients that have student loans, whether they're in deferment, whether you have an income-based repayment plan or just a standard repayment plan. I know how to work with those, and I can explain those to you on a case-by-case scenario. But just know, if you have student loans on your credit report, we care about those. Any personal loans that you may have with the bank, your credit cards, we're only going to use the monthly minimum payment. So it's not going to be the entire balance or anything like that, but we will count up all those monthly minimum payments and use those. Any other mortgages that you have and you're going to retain, those are included in this DTI ratio. The other things that we do care about is alimony and child support, if you're paying those. All right, what's not included in this debt to income ratio? Rent payments. We don't care about rent because it's going to go away when you buy a home. We don't care about your utilities, ever. Those don't matter in this debt to income ratio. Auto maintenance and gas. So any of those things related to the cars that you own, we're not going to care. I don't need to see a cell phone bill. We don't care how much you spend on groceries, gym memberships, health insurance. These things are not counted in the debt to income ratio. All right, so let's do a real world example, okay? Again, we're going to buy an $825,000 home, and we're going to assume that this particular borrower has income of $240,000. If we divide it by 12, that's $20,000 of income each month. Right. And then the debts that we're going to assume here are 2 car payments, one of $1,200, one of $800, some credit cards, and we add up all those monthly minimum payments. So now we have $350 a month there. And these are my kind of people. They've got a boat. And so they have a boat loan, and that's $850 a month. All right. So we're going to add all of those up. That's going to be the total debt that we're going to use. Now, if you're unsure what might be on your credit report, you can go to Experian, TransUnion, or Equifax and request copies of your credit. You can also go to www.annualcreditreport.com and get a free annual credit report. And that's something that the government did for us a while back. So those are some free ways that you can get access to your credit report. I will also tell you that virtually every credit card company gives you access to some sort of credit monitoring system. And while the credit score that you see there isn't going to be directly applicable to the mortgage industry, we have a different algorithm that we use. You can see what's on your credit report and if things look correct or not. Okay, so that's another really good way to see what's being counted against you here. All right, well, let's talk about the approval. We will come back to the math here in just a second, but There are multiple different loan programs that we can pair most people with, and they all have different guidelines, and they're all looking at compensating factors too. There may be some good compensating factors, and there may be some negative compensating factors on your file, and that's okay. Whatever it is, we'll deal with it. But in this particular situation, the $825,000 purchase price, making $240,000 a year income, we're only going to be looking at a conventional loan product. Now that we know what product we're going to use, we need to talk about these debt-to-income ratios. And there's actually a front-end ratio and a back-end ratio. I know that might sound kind of silly, but that's just what we have. The front-end ratio is simply the new monthly mortgage payment divided by your income, okay? The back end ratio is simply the mortgage payment plus your monthly debt divided by income, okay? That's it. And so with conventional loan products, we don't ever want to go over 50% total debt to income ratio. In fact, the real answer is about 47%, but we're using 50 here for simple math. I drew a line through FHA and I drew a line through USDA. You can see the debt to income ratios on the front end and the back end there, but there are, FHA only goes up to a certain dollar amount, and we're going to exceed that with this purchase price. And USDA is income based, and so we're gonna exceed that as well. This person could qualify for a VA loan. I didn't run the example here, but I did want you to see that most people in the industry think that a really safe benchmark for your front end and back end ratio is around a 28% and a 36%. So again, real simply put, all that means is that you would take 28% of your income, and that would be what you would allocate towards a monthly mortgage payment. You would take 36% of your income, and that's what you would allocate towards the mortgage payment and all of that other debt that we care about that's on your credit report. So that's like a more conservative estimate. And so you can make the right decision for yourself, but I wanted to share that information with you. Okay, let's come back to our example. Again, gross monthly income is $20,000. And I didn't say this earlier, but the really cool thing about the income that we use in the mortgage world is that it's the big number, right? It's what you really make it work before taxes, before any insurance deductions or whatever else it is that you have taken out of your paycheck. So we're using the big number. You get credit for that full amount that you're earning every day. So we're going to take that $20,000 and we're just going to assume that total debt to income ratio of 50%, which means that we would be able to use $10,000 of your monthly income towards your new mortgage payment and all of those expenses from the credit report. Okay. So what we need to do first is we need to subtract out what was on that credit report. So we've got this $10,000 of income that we can use, and we're going to subtract out $3,200. And I put there in parentheses, that was the 2 car payments, the credit cards, and the boat. Right? So then the residual income, what you have left over, is $6,800. And that's what we can put towards your new monthly mortgage payment. So this new monthly mortgage payment has several components to it. The largest portion will be principal and interest almost all of the time. Okay, then what I see really commonly is property taxes taking up the next big chunk. Then you have HOI, which is homeowners insurance, HOA, which is any homeowners association fees. They may or may not apply to you. And then some people will have PMI, private mortgage insurance. If you put less than 20% down on a conventional loan, you will have a PMI factor in your monthly mortgage payment calculation. So let's come back here. We had $6,800 left over. That was the residual income after doing all of the math. And that's what we're going to have to spread out amongst all those different components of a monthly mortgage payment. I'm just assuming 5% down in this example. So if we have a purchase price of $825,000, our loan amount is going to be $783,750, and you can see on the screen you're going to put about $41,250 down. You will have some closing cost. All right. So you would need a little bit more money than that, but we're keeping it simple for our math problem here, but that is the down payment portion. Okay. So what would principal and interest look like, Linda? Well, I'm going to show you here at a 5, 6, and 7% interest rate. Okay. This is not a commitment to lend. This is just an example so you can see, based upon wherever interest rates are at when you're watching this video, you can get a gauge as far as what that monthly principal and interest portion would look like. So at 5%, it's a little over $4,200. At 6%, it's just kissing $4,700. And at 7%, it's just over $5,200. So that's how that principal and interest portion is going to change based on those 3 different interest rate scenarios. We would need to add PMI. We would need to add taxes and insurance and an HOA fee if applicable. Almost every time I'm going to say that this loan would be doable for this client. I would do this math real quickly with them on a phone call and ask some questions. And this would be called a pre-qualification because we're just kind of doing an exchange like how we're doing here together, where I have some basic information. I'm going to crunch some basic math. I would say, you know what, Jay and Sarah? This is going to work, I believe. Based upon what you've told me and the math that I've done on my end, it looks like you're well within the range of a home that you could afford. And then at this point, I would share my online application link, have them make formal application. Then I could pull their credit. I could look at their pay stubs, their bank statements, their tax returns, and I could confirm the information that we've shared back and forth, run their file through the automated underwriting system, and fully pre-approve them. So that's how we take the next step here. But this is what we do all the time to make sure that we're playing in the right sandbox. But listen, the best tip I can give you is to not max out your payment, right? There are some times where it makes sense, right? But overall, don't max yourself out. Save some money for a rainy day. Because if you haven't owned a home before, here's what happens. You end up being house poor. Like, remember all of the things that you like to do now before buying a house, okay? Make a list of those. Maybe you play in a softball league. Maybe you like to go out every Friday night because you're a foodie and you want to check out a new restaurant and a craft cocktail. Maybe you like to go on long weekends once a quarter. What is it that you like to do and how much money does that cost? And make sure you're still earmarking money in your budget for that. You don't want to be so house poor you can never leave and you can't go have the fun that you used to have, right? You're also going to want to budget for repairs and maintenance. And based on the size of your home, and typically an $825,000 home is a pretty good size home, right? You need to be realistic about the age of the home. What are the things that you maybe need to start saving for? You know, what kind of things could creep up on you? And I also want you to know that lenders apply this formula to all borrowers. For the most part, the approval process is a math equation. And so we will gladly give you the maximum amount of money that we can approve you for per the guidelines. So it's up to you to think about the other components, the human element, right? Of, okay, well, I can get this, but I think I should stay down here. All right. But the most important thing for you to know from anything that I've shared with you today is that I am always here for you. You can call me, you can email me, you can text me. In the description below, in my channel description, you can get 15 minutes on my calendar with just the click of a button. I know you're busy, but that will at least allow us to connect so I know what's going on with you and how I can help. And then if we can't solve it in that time frame, we'll set up a time to talk even more. So please do not hesitate to reach out. It would be my greatest pleasure to help you. If you do need more information, do that. Book that planning call with me. But you can also request my free Smart Homebuyers guide. And that'll allow you to see just kind of how I share information, and it'll give you a wonderful reference guide for the entire home buying process. I hope you enjoyed this video. Have an amazing day, and we'll see you next time.